Welcome to StokTok's deep dive into TotalEnergies. TotalEnergies is one of the world's largest integrated energy companies, operating across oil and gas exploration, production, refining, and renewable energy generation. The company generates revenue from selling crude oil, natural gas, refined products, and increasingly from solar and wind assets, serving industrial, commercial, and consumer markets across Europe, Africa, and beyond. As of May 8, the stock is trading at $88.48, positioned in the middle of its 52-week range, which has run from $57.26 on the low end to $93.67 on the high end. Let's work through the fundamentals, scene by scene, starting with a quick business overview. TotalEnergies operates an integrated business model that spans upstream oil and gas production, downstream refining and marketing, and an expanding renewables segment. The company's competitive moat rests on its large reserve base, its production scale, access to capital, and long-term supply contracts that provide stable cash flows. In a commodity business like energy, cost control and geographic diversification become critical. TotalEnergies has both. The StokTok score is 44 out of 100, which signals caution. Breaking down the 5 dimensions, valuation grades solidly at 17 out of 20, but financial health sits at only 7 out of 20. Profitability and growth both score 6 out of 20, and smart money positioning scores 8 out of 20. This is a company that looks attractively priced, but carries meaningful financial and growth headwinds. Now, valuation. The question every investor has to answer: are you paying the right price? TotalEnergies trades at a price-to-earnings ratio of 13.81 times on trailing results and a forward price-to-earnings of 13.58 times. In the energy sector, multiples compress during commodity downturns and expand during supercycles, so context matters. The PEG ratio, that is price-to-earnings divided by the expected growth rate, sits at 0.85. Suggesting that valuation is reasonable relative to expected earnings growth. The enterprise value to EBITDA multiple is 5.72 times, and the price-to-sales ratio is 1.11 times. Structurally, these multiples reflect a mature commodity business trading at a discount to the broader market. Our DCF model suggests the stock is trading at par, 0% margin of safety, meaning the market has already priced the company at its estimated intrinsic value with no buffer for error. Wall Street analysts have a consensus mean price target of $97, with a high target of $106 and a low of $77 from 7 analysts covering the name. That implies roughly 10% upside from current levels. The next earnings report arrives on July 23, 2026, with consensus earnings per share estimates ranging from 1.98 on the low end to 4.20 on the high end. Taking both signals together, a reasonable fair value range in our view sits between $90 and $110, representing limited upside to modest downside from current trading levels. Market sentiment around TotalEnergies leans bullish, driven by elevated oil prices stemming from geopolitical tensions and exceptional earnings results across the major oil complex. The company has raised both share buybacks and dividends as profits surge, signaling management confidence in the business outlook. Moving to financial strength, how solid is the foundation? The Piotroski F score is 6 out of 9. This 9-point financial health checklist examines profitability, leverage, liquidity, and operational efficiency. A score of 6 indicates moderate financial quality with some concerning trends. The Altman Z score, a bankruptcy risk model that weighs profitability, leverage, liquidity, and operational metrics, sits at 1.55. A Z score below 1.81 enters the distress zone, and TotalEnergies is flashing yellow here. This warrants careful monitoring, particularly if commodity prices roll over or leverage metrics deteriorate further. The cash-to-debt ratio is 0.47, meaning the company has roughly 47 cents of cash for every dollar of debt. That is tight. However, the interest coverage ratio, operating income divided by interest expense, is a healthy 9.02 times, indicating the company can service its debt obligations comfortably. The current ratio, a liquidity measure, is 1.08, suggesting adequate short-term liquidity, but it is working on thin margins. Debt to equity is 0.52, which is reasonable but not conservative. The balance sheet carries meaningful leverage relative to equity capital. From a credit analyst's perspective, the company is solvent and covering its obligations, but balance sheet flexibility is limited. A sustained commodity downturn or major capital disruption could constrain financial maneuverability. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 6.38%. Return on invested capital measures how effectively the company deploys shareholder and creditor capital to generate profit. A 6.3% return on invested capital is soft for an energy major with a century of operations and a global footprint. For context, businesses generating double-digit return on invested capital are creating true shareholder value. Single-digit return on invested capital suggests the business is earning less than the cost of capital in many scenarios. The gross margin is 30.87%, which reflects the company's ability to capture margin on the spread between commodity prices and production costs. Operating margin is 12.89%, a decent conversion from revenue to operating profit. Net margin is 8.21%, showing that after interest, taxes, and corporate overhead, the company retains roughly 8 cents of every sales dollar as profit. The free cash flow margin, cash available to shareholders and debt holders after capital expenditure, is 5.86%. That is the critical metric for energy companies. A 5.9% free cash flow margin means the company generates roughly 43 cents of free cash per share from each dollar of revenue. Recent earnings reported a net income of $5.81 billion on revenue of $49.52 billion, corresponding to a net margin of approximately 11.7% in that quarter. The headline was a miss on earnings per share expectations. The company earned $1.73 per share versus a consensus estimate of $1.77. Profitability is solid but not exceptional, and capital intensity constrains cash generation. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is negative 14.4%. This reflects the cyclical downturn in oil and gas prices that occurred before the recent recovery. Revenue growth over the trailing 5 years is positive 11.3%, a less alarming picture when you extend the time horizon. The business did grow on a per annum basis before the recent contraction. Book value growth, a measure of equity accumulation, is only 2.5% over the past 3 years. That is anemic. For a company reinvesting heavily in energy transition and operations, book value should be climbing faster. The most recent quarterly results showed revenue growth of 7.8% year over year, a sign that the recovery is gaining traction. However, the longer-term trajectory matters more than any single quarter. The company's dividend yield is 4.25%, which is compelling for income investors, but also suggests the market is pricing in modest total return expectations. Energy companies that trade on yield alone typically face structural headwinds to capital appreciation. Management's guidance on production and capital allocation will be critical when the next earnings call occurs on July 23rd. The growth picture is decidedly mixed. Near-term commodity recovery is masking a long-term structural challenge in a business facing transition away from fossil fuels. Now let's talk smart money. What institutional capital is actually doing with this name? 11 top-tier investment gurus currently hold TotalEnergies in their portfolios, a signal of broad institutional quality-focused interest. Among 13 F-filers, the largest institutional investors required to disclose holdings quarterly, 8.1% are net buyers, meaning slightly less than 1 in 12 institutional shareholders are adding to positions. That is a lukewarm signal. You would want to see double-digit net buying for genuine enthusiasm. Insider ownership among company insiders and executives is 0.03%, essentially negligible. Management owns almost nothing. Over the last 3 months, there were 0 insider buys and 0 insider sells, indicating either management confidence expressed through other means or lack of conviction. Among the named Guru holders, Tweedy Brown, a respected value investor, holds 0.85% of its portfolio in TotalEnergies, but has been reducing its position, selling down by 12.94%. Richard P. Zena, through P. Zena Investment Management, holds a tiny 0.01% allocation, but has been adding to the position, buying up by 6.96%. The divergence between Tweedy Brown's selling and P. Zena's buying is noteworthy. It suggests respected value managers are divided on the near-term outlook. Tweedy Brown's reduction could reflect a view that commodity prices are overheated, while P. Zena's accumulation could reflect a conviction that the valuation offers an adequate margin of safety. And finally, the verdict. Let's bring it all together. Valuation. TotalEnergies trades at a fair price with no margin of safety and analyst targets suggesting roughly 10% upside, implying the current risk-reward is balanced but not compelling. Financial strength. The balance sheet carries concerning leverage and sits in the distress zone by Altman Z score. This is a company with limited financial flexibility. Profitability. The business generates acceptable returns but falls short of double-digit return on invested capital thresholds, indicating mediocre capital efficiency. Growth. Both historical revenue trends and forward visibility are weak, with near-term commodity strength masking long-term structural challenges. Smart money. Institutional positioning is mixed, with some respected value managers selling while others accumulate, signaling disagreement on the outlook. In our view, a fair value range for TotalEnergies sits between $90 and $110, representing limited upside to modest downside from current levels. The most recent earnings results reinforced a mixed message: solid profitability in a strong commodity environment, but a miss on earnings per share expectations, and a long-term growth profile constrained by energy transition headwinds. The setup here is a mature energy company trading near fair value in an elevated commodity cycle, offering yield and defensive characteristics but limited total return upside over a 3 to 5 year horizon. The bull case rests on sustained oil and gas demand, management's commitment to returning cash to shareholders, and a reasonable valuation floor. The bear case rests on long-term energy transition risk, weak revenue growth, tight leverage metrics, and management owning almost nothing. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on TotalEnergies. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.